Yeah, hello. My name's Andy Home. I am senior metals columnist at Thomson Reuters, and your go-to stop for all things concerning the London Metal Exchange metals.
Andy, good to see you again. It's been a while, but lots and lots happening and lots to talk about. LME Week recently in London. Were you there? What was the news?
Yeah, I was there for about the for however many years running. Listen, a couple of observations. So, at one level, when you attend all the seminars, the conferences there. The leitmotif once again was the energy transition, right? And metals role in that. What's changed though since last year is a realization that this is not going to be a one-way bet for metals, right? Because we're meeting at a time when the price of lithium is bombed out, the price of nickel's bombed out, the price of cobalt's bombed out. All these metals are sort of like, the electric vehicle battery metals. So I think there was kind of appreciation that this road to energy transition is going to be a lot bumpier and a lot more complex than people thought it would be. Now, away from the conferences and into the cocktail parties, if you like, right, when you're mixing with the traders, they came into that week pretty euphoric thanks to China's fiscal stimulus program, right? But then obviously as the week wore on, there was a growing realization that maybe it wasn't quite as fantastic as everyone had initially assumed. And that itself is becoming a bit more complicated story than just hey, let's go and buy metals because China has announced, X, Y, and Z.
It's kind of interesting. I think every time China does announce a stimulus or the opposite, the market is in paralysis. Yet at the same time, the conversations at the cocktail parties, whether it be metal traders or industry more broadly, is that stimulus packages in the US are up and coming, yet to be seen. Same for Europe. Yet to be seen. There's lots of politics to be thrown around there, and that's always it complicates things because things are said without any substance to them. Do you think that we're going to start to see a bit of a change in the metals market going forward? Given all the news that's being put out there, surely it's got to get going again. As you say, lithium's down, rock bottom. Tin, cobalt, everyone's under pressure, it seems, except for copper at the moment. So what's the way forward?
Yeah, we could sort of like talk in the generality for all industrial metals. Why don't we start with that first, right? So however excited we get about the energy transition, the new economy, we have not escaped the old economy, and that's the one that was driven by Chinese manufacturing, right? You saw the reaction, right? As soon as China announces something, hey, this is now like a big indicator to go along or whatever, right? I think that is changing. I think that is changing for the reasons you said. I don't think China is going to be the same growth driver for metals going forward because we're going to get better growth in North America, in Europe as well, right? So I think that's one of the shifts that's currently taking place. But you can see it's like an old junkie, but still addicted to the Chinese news, right? Because it's still a mega. I would say, though, I am not an economist and I don't really count myself as an expert in China, but I was watching the market's reaction to that announcement as ever more emails dropped into my mailbox from people who are qualified economists and are about to know a lot about China to say it's not enough. All they're doing is putting a floor underneath, a sliding property market. This is not enough to turn things around. Okay, then let's just carve out, if you like, the electric vehicle sort of metals here, right? Because they've got another issue as well. I think it's kind of people assume, no one's buying EVs anymore. The whole thing's gone into reverse. That's not true. You saw like new energy vehicle sales are still like growing really strongly globally, right? Two things have changed. One, there's the mix of what sort of electric vehicles people are buying. Specifically, a lot of people want to go for hybrids, and that applies in China as much as it does in Europe, and that's less lithium. Very good news if you're in the platinum and palladium business because they do use catalysts, right? But the other big problem is in all three of the markets I mentioned, you have seen China massively overproduce. The world has overproduced all three, but China is the leading cause of overproduction in lithium, nickel, and cobalt, and that has crushed prices. There's just simply too much supply, even for a still very robust electric vehicle like sales space.
I mean, do you think, again, when we're sort of looking at this metal space, there's certainly around the battery, it kind of feels like the data, the available data, it's a real mixed bag. And I have to question maybe some of the expertise that's being touted. You know, we've covered this in the nickel space quite a bit. There's not a lot of real kind of deep knowledge, it seems, in the industry, certainly not from the banks. That doesn't help. We get stories coming out of, in Indonesia's ability to supply the world with everything it needs. But, what's the actual reality? And I think, therefore, for punters like me, trying to make sense of it all in terms of using all this kind of disparate and quite polarizing data, it's hard to know how to look at it. I mean, is there? I mean, as just we come off the back of LME week, we had all those issues last year. I mean, are things going to be tidied up a bit in terms of the access to data and the type, the quality of the data?
Welcome to the metals market. I mean, we are a data
Right.
impoverished
Thanks.
sector of the financial universe, and that has always been the case, and that remains the case, right? I know analysts who kind of work in metals now. They worked in the energy sector. One was saying to me he was expected by his clients to produce a gas supply and demand balance analysis every single week. He could do that because the data was there, right? But when we get into the world of metals, we don't really know fully how much the world produces in most cases. We certainly don't know how much it consumes. Metals is a very malleable thing. You melt it, right? So where do you count it? What do we make of China's statistics? No. We are, as I said, relatively impoverished when it comes to data. I mean, I always say, you really want to understand what's going on in any of these markets? Look at the price. It will tell you. If the price is bottomed out, it's bottomed out for a reason. That's called oversupply, right? And then it's just a case of like your estimate or my estimate against how much oversupply we're looking at.
It's kind of funny. We've seen this in uranium as well. There was a spike at the beginning of this year, actually, end of last year, beginning of this year, rushed up to 106. But it wasn't off the back of much trading. It was only off the back of one trader trading as well. Went up to 106, but settled back down, and they sort of low 80s now. But it seems there's a lot of, for the traders, not a lot of data shared unless they want to trade with each other. And even then, they're misleading each other, it seems, because the number of proprietary trading systems out there. And I think that's a real issue for the space when trying to make sense of it. And these sort of wild swings to, trying to understand the liquidity situation in China is perhaps a little bit digital, not digital, analog age rather than digital age. We shall see what happens. Shall we talk about maybe getting some of the metals out there? And I know you put out a huge volume of content always, and I think we've just been talking about China, so maybe we should continue along that vein, and maybe on lead and zinc again. How's that market?
Well, I mean, lead is not probably the most exciting of industrial metal market. It's resilient. It tends to be very steady in price. It's because so much lead comes from recycling, which itself is a really sort of steady stream of material into the marketplace, right? That's the highest recycling rate of any sort of like metal. But what happened a couple of months ago is China, which has been a major exporter of refined lead to the rest of the world, suddenly turned major importer in a big way. I mean, it's imported more in a couple of months than it has in sort of like years, frankly. What's that down to? That's down really to one thing. First and foremost, there was a squeeze on the Shanghai Futures Exchange, right? And this is how the world of metals trading is not just about London now. We've got to look at what's going on in Shanghai, right? There's a long-running standoff between bulls and bears in that market. A lot of us have been watching it for quite some time. Right? It climaxed a couple of months ago. So you saw, a huge premium for the cash delivery on the Shanghai relative to forward months. And you also saw a huge premium for Shanghai over London Metal Exchange. The physical market has reacted by shipping huge amounts of lead into China, right? So that was the trigger. And it remains to be seen sort of whether, as that squeeze subsides, and it is, whether the imports will hold. kind of worth thinking about what's going on behind the squeeze, though, because China's the biggest producer of lead in the world, right? So, yeah, there were some specific issues about what could be delivered onto the Shanghai Futures Exchange. But when you start looking at the numbers that you can get hold of out of China, and I look at local data providers for my production numbers, hey, listen, their production's falling hard this year. On the primary side, which is the guys who take mine material and make it into refined lead, well, that's a very tight marketplace globally. And you've seen imports drop quite significantly of lead concentrates. The bigger part of the equation, what's going on with the battery recycling side, though, in China, right? And, I saw a statistic the other day, which said that September secondary production, as we call it, down 33% year on year. And that's because a lot of subsidies have been changed for recycling. There's been rule changes to the local government. No one's quite sure. You're talking into a really opaque part of the market there, right? But, if we don't see a recovery in production in the world's largest production, we've got to ask ourselves the question, was this all change to being a big buyer of overseas metal? Will that persist beyond the Shanghai squeeze? Question out. We will find out. We are very interesting east-west imbalance, if you like, between price and availability.
Yeah, and I guess it comes back to that data point we made earlier. All of a sudden you've got, nearest down at 70,000 tons being bought by China, as say previously, barely anything for years, and now, the trouble is the ex-China part of the market is, there's a lot of lead out there and it's not very sexy and not many people understand much about it. But when something like this happens, it kind of gets people excited. And I looked at things like what happened with lithium last year, obviously went on a tear in October, November, or was it the year before? So got everyone super, super excited. And, the inevitable crash comes. And even with the LME, issues with the LME, the nickel of, over 18 months or so ago, there's got to be lessons learned here. And this comes back to this data point. People looking at China don't really know what the actual numbers are. Very few people do. Very few people ask the question. And for how does the West play this? Because you can get caught out. It could be a lot of value destruction if there's not some kind of understanding of this consistency of supply into the market and pricing. So what's to be done?
Yeah, I think there's kind of several questions wrapped up into one there to some extent. Look, it kind of depends which way around you want to see it. I mean, the US government has made some pretty aggressive statements about what it regards as China's energy metals policy. You are deliberately flooding the market to push us out of business, to keep us dependent on your supply and keep us leveraged to importing from you, right? That's one view of it. I would also point out that there's a deep Chinese history here of essentially the government decides that it will accord some commodity strategic status. Now, I'm going to go back 30 years or so now. This happened for aluminium, right? Not a big producer 30, 40 years ago, but it was decided it's the metal of the future, right? And what happens under those circumstances is the credit taps are turned on for aluminium projects. I mean, realistically, you and I, if we're at the right place at the right time, go to our local bank and said, you wouldn't lend us $50 million the other day to set up a chemical plant. And go, yeah. What about double the amount for aluminium? And suddenly it's available. And, you get an explosion in capacity growth. And then at some stage of that cycle, the Chinese authorities will go, whoa, guys, we built too much. Or what they call, there's been too much blind investment. And you'll see a steady controlling hand, if you like, a restraining new growth. In the case of aluminium, they've actually put a capacity cap now to national production, right? So there is a history of this kind of what should I put it, investment over exuberance, because of the government has said, this is where the free credit is. This is the cheaper credit for you guys to go and build this stuff. And I would say this also. I mean, for me, that's probably, I mean, what's going on in lithium and nickel to some extent. I have some sympathy for where the US is coming from, but do I really think that's the primary driver? No, I would think that would be viewed as a useful byproduct in Beijing if it's causing Western competitors problems. But from solar panels to aluminium, this is how China goes about investing. It's massively state subsidized. It's a different system, right? And we do have to accept that. What's the answer? Very difficult, really. But I think what you're seeing in the United States is they wouldn't like me putting it this way, but if you can't beat them, join them. And you've seen the U.S. Department of Defense, the U.S. Department of Energy invest directly in metals capacity.
Yeah, and I think it's difficult for companies to go up against sovereign states, especially one like China. I think it's hard enough for the U.S. government to try and do that, let alone companies. And I guess that's the point I come at is when banks and funders have had huge amounts of money destruction over the years because of the antics of, let's just say, the secondary or byproducts of Chinese behavior, it means that the money tends to shy away from that, and that perpetuates the supply issues, the supply delta into this kind of growing demand. Like I say, I'm not sure what the answer is, but maybe these critical mineral lists better start meaning something.
I think I think one part of the answer, and both the United States and the European Union were talking in these terms, is what can governments do to de-risk projects in the West? And sometimes that may be involved. I mean, giving loans, for example, at discounted rates, but it may be kind of you've got to see it in a much broader sense of what holds a project back, a mining project. What holds people back from investing, say, in Congolese copper or cobalt? And, one of the interesting side shows in this debate is taking place in African railway lines, right? The Lobito Corridor Railway, which has been backed by the US and international partners, will link the Angolan port of Lobito with the copper belt, right? Because one of the things people go around when they say, well, we don't want to invest in the DRC is going, well, there's no railway line. The only railway line goes east into Mozambique, and that's Chinese material flowing down that. So what have we built? Our own railway line. That de-risks the area quite significantly, right? What if we could give development capital to completing the hydroelectric dams on the Congo River? Would that de-risk your energy worries? So there's a lot of de-risking is the operative word, and it goes from the big macro plays such as in Congo. But I think the European Union is also saying, how do we de-risk smaller projects? Yeah, what can the European Union, as a series of institutions, do to make it easier for people to sort of get projects off the ground, even with this price volatility, right? So I think this is a really fast evolving policy area as people start thinking through what's going on here. I don't think the West is powerless against Chinese dominance, if you like. But I mean, obviously, this is a kind of a very new debate for the West to have, if you think about it. We've had similar debates in the energy sector for 30, 40, 50 years because of our dependence on Middle Eastern supply, right? So give it some, but I do detect this acceleration momentum of government-led efforts, and they understand we can't just leave this to free markets. The free markets will tell you that you don't get any project off the ground at the moment. So de-risking is the buzzword in both Washington and Brussels at the moment. Let's see how effective that policy can be applied.
Yeah, no, I think we saw it recently. There's coming together of 14 nations with this kind of MSP fund for critical minerals, and I think there's a conversation in I think it was in the US, suggesting, and the room was filled with the big banks for the first time in a long time. Big banks paying attention because government is asking them to fund world-class projects for the benefit of the US critical minerals list. It'll be nice to see that translate into action. A lot less conferences, a lot less promises, and a bit more action, please. To quote Elvis. So we should see how that continues to play out in the marketplace at the over the next sort of 12, 24 months. Um, we should sort of probably get back into the metals side of things as opposed to just pointing out all the things which are wrong with the space, and which is zinc. What's going on at the moment in the zinc markets that we need to know about?
Yeah, I mean, well, yeah, the zinc has experienced quite sort of like unpredictable supply dynamics. I mean, over the last couple of years, right? I mean, we've seen smelter bottlenecks and sort of oversupply of raw materials, and now we've flipped that around. We seem to have a shortage of mine raw materials to smelter sort of capacity. It really depends. I mean, again, we're in a situation that we are not short of zinc right now, right? You look at LME stocks, they're high. Shanghai stocks are relatively comfortable, right? But there is definitely raw material squeeze going on. And you see that, I mean, the smelters treatment charges are extremely low. This kind of results in some ways, it's just simply a result of the last cycle for zinc, right? I mean, price went too low. Lots of mines sort of like shuttered. It was quite easy to sort of like put a zinc mine onto mothballs. You saw the Tara mine in Ireland be shuttered. Aljustrel in Portugal was shuttered. And suddenly, before you know it, hey guys, where's all the zinc concentrate gone? Well, we just sort of like closed it down because the price was like. So to some extent, we're all expecting the prices are better. This is a classic commodity price cycle, right? Not enough of the stuff, incentive price, let's get it open again. Tara actually has already announced that it will be reopening. I think it is reopening as we speak and ramping up. So this is a passing phenomenon, but one that is really sort of like, yeah, I mean, it's squeezing the supply chain a little bit, right? That's masked by quite high inventories of metal. But yeah, it's you're a zinc smelter at the moment. It's quite tough times to get, I mean, like material in at a margin positive level.
Right, and again, cause and effect, right? So China's got the biggest kind of smelter network in the world. They're the ones who, I guess, struggling a bit at the moment. Or are you talking about smelters ex-China?
Well, everyone, but of course, obviously, China
Right.
is the world's largest smelting sort of complex in the world. I mean, it is going to bear the brunt of this, you know. It is also the country that has expanded its zinc smelting capacity most in recent years, as it has for copper, as it has for lead, by the way. And again, going back to that over exuberance, maybe you just built a little bit too much smelting capacity, at the wrong time, guys. And now we're all chasing sort of like down like raw materials for it. But yeah, I mean, certainly. You always know there's a problem in China when very occasionally all the top smelters have a big meeting and they come out with it saying, well, we have agreed that we are going to curtail production now. Whether they do or they don't, it sometimes remains to be seen, but take it as a sign, a signal that they're hurting on their bottom line, right? For even to try that sort of coordinated action. I think it's more price signaling than anything else. And actually, here's what we ought to agree to cut over the next 12 months. But the very fact they're trying to do it tells you that there's stress there.
Right. I guess all metals do this. And as someone investing in this space, this volatility is good news. However, for the industry, this erratic behavior of these metals is problematic because it's as you've just described with zinc, the impacts are big and deep. If the price isn't right, production shuts down into supply, and all of a sudden, we're down sort of 10% by the end of this year. And that's not healthy.
There is another dimension here as well, which we should mention. Look, at least in zinc, if I want to, I have the option of hedging my forward price risk, right? I can use the London Metal Exchange for that. One of the problems that you've seen in something like, say, lithium is there wasn't that option. The most liquid contract, the only really liquid contract was in China, right? Which is no use to anyone who's trying to hedge outside of China. So, you've got to ask whether that lack of financial capacity exacerbates the boom-bust cycle because guys can't lock in what they need to lock in, right? Now, that again is slowly changing. The CME has got a lithium contract which is building up liquidity. industrial hedging can get people a long way as long as they do it. I mean, in a positive manner, a constructive manner. The problems are particularly there, and lithium springs to mind when you don't even have that option out there, right?
But is it a case like lead and zinc, being around a while, and these are all quite small markets we're talking about. That's the other kind of thing we need to understand. Very few people can affect things, in a significant way. So we need to understand that in the context of global investing. But lithium, for instance, had that erratic behavior, and I think that was a salutary lesson for lots of investors. I'm going to come in from an investor perspective. I appreciate you won't. You learn that these kind of big swings have also then, on the up is fantastic. Everyone gets excited and think it'll go on forever. But the reality is they also have, quite a big reaction as well, because the market demand isn't growing much. If you look at like zinc, in terms of the demand side of things, that doesn't really grow significantly, year on year. Was it what 2-3% on average? Is that right?
Yeah.
About that. So these kind of like having, oversupply and then mothballed projects, it's great for investing, but not good for industry. And I think we can say the same of lead and other metals too. With lithium, though, it seemed to be a bit more complex in the sense that because of this reliance on the China factor for the technology, the solving the extraction part of the equation, that China was always going to be able to influence price, and that funders in the West perhaps were, I guess, encouraged not to fund into a business which needed some kind of, China had some China influence over their ability to make margin, because they were sort of in the Chinese supply chain in some way, shape, or form. Do you think that's going to recover? I mean, it seems to, as you say, hit rock bottom. You got to hope, haven't you? What's that recovery look like?
Well, I mean, it's from a market kind of guy like me, you've hit a level when who's going to short it from here, right? You're already at I mean, how much further downside is there for lithium? You already see sort of like major operators mothball their plants. Even the Chinese are having trouble, sort of like on the cost basis, right? So from that point of view, it's hard to see like how it's going to collapse further from this current pricing level, right? The question then arises is sort of like how long does it take for supply and demand to rebalance? This is a market that has been characterized by particularly strong boom bust cycles, right? People get overexcited trying to bring too much on. I think there's another problem here though as well. We should kind of reference that. From an investment point of view, you've got two issues really. You've got the price cycle, but you've also got the technology, right? There are Western producers who have been producing for many years lithium, but starting up a new lithium extraction plant, you're going to need a lot of expertise to do that. And of course, the specifications for your battery manufacturers are so tight, you may spend a year just trying to get accreditation from them, right? Now, this is where it gets interesting. Again, late to the race, let's see what the West can do. Because I think a lot of people now are looking at a next generation of technology. It's called direct lithium extraction, right? It's kind of cleaner on the whole. It can be considerably lower cost depending on when you're operating. Lithium didn't really exist as an industry much 20 years ago, right? And okay, the Chinese have definitely stolen the first march, and you're absolutely right. But it's not as if we're all just going, oh my God, what can we do? Nothing. No, there's a lot going on, I think, there. But part of that is getting a more reliable technology. As I said, you can have the best lithium sort of deposit, the brine deposit in the world, and you can have the lithium price going up. If you can't master that technology, and this is an industry, I mean, a lot of this is very new technology. It's very difficult technology. It's more akin to sort of like a chemical technology, chemical processing than it is to metallurgy, right? So that's another thing I think that investors are kind of on. It's a double dilemma, if you like, for if you're a lithium investor, right? Because one, you've got this boom bust price cycle with up to now very little way of hedging that in any way, right? But secondly, a lot of a lot of newcomers to this market have struggled and will struggle to master what is very sophisticated processing technology.
Yeah, no, I agree with that, and I think we in the West have got to get to grips with the technology, whether it be DLE, whether it be brines, whether it be hard rock. They have a degree of complexity to the chemical solution that they're gonna need to come up with. We need to talk about the Rio's deal with Arcadium Lithium, right? That's a big transaction that's happened there. And the reason I think it's important to talk about this is because I speak to lots of lithium wannabes, many of whom say we can supply all the lithium the West needs, right? Big claim. Long way to go, long journey that they've got to go on. But, there's an existing market here, which is, again, as you just referenced, relatively nascent in the sense that it was quite a small industry up until maybe even like I would argue, 10 years ago. So tell us, why would a company like Rio go and spend $6.7 billion on Arcadium Lithium?
Couple of reasons. First off, it's obviously taken what I call a medium-term view of the lithium market, right? I mean, so beyond the current slump we're in. As I said, it's not as if, the electric vehicle transition has suddenly come to a complete standstill or gone into reverse. It's simply not true, right? It's been it is a bumpy road, but until someone invents a better battery using a metal other than lithium is kind of going to be the drive initiating the vehicle transition, right? Is it going more slowly than people hope? Absolutely. Is it going to stop? No. Will we need more lithium in the year 2030? Yeah. Will we need even more lithium in the year 2035? Absolutely no doubt about it. A company like Rio has got the financial muscle to be able to sort of take that view, right? Secondly, I think, and my colleagues have written this at Reuters, is, Rio has a massive lithium deposit in Serbia, but is facing massive popular resistance to actually, getting it developed and all that.
And Argentina, of course, as well.
And Argentina, which I think it's just starting up its pilot plant. So, but with this acquisition, it really just jumps wholesale into being a producer, right? But I think Arcadium also has something that Rio's really interested in. You remember what I was saying about some of this new technology for processing lithium? Yeah, Arcadium has been doing a lot of work on that, and I think Rio is very, very interested in that as well, right? And, if you're really cynical, if you're going to buy something like that, why not wait for the price to be bombed out?
Yeah. Contrarian investing.
Opportunistic moments here, right?
Yeah. Yeah, and I'd say that's true. If you look at the kind of the equities, the lithium companies, public companies, the equities have been absolutely crushed and getting access to capital. The big banks have bought into the fact that maybe China can continue to flood the market and can control price going forward. And I think the slight drop off from pure play electric cars through to hybrid, of people trying to work out what those numbers look like going forward. Certainly, the bankers have given pause for thought on that topic. So, but again, I'm encouraged that companies like Rio are kind of stepping in here and going, well, actually, we think there's perhaps a more sensible, accretive growth plan and demand, more importantly, for lithium coming down the line. So that's interesting to me.
And also, Rio has the advantage is it's not going to be a single commodity house, right? So I mean, it wants the lithium, but let's face it, it's a massive producer of copper. It's a massive producer of iron ore at the moment, right? So it is a byproduct revenue stream in a way that a lot of junior guys, they are single commodity plays, and they're often single asset plays. Which of course means naturally a much riskier sort of like proposition, right? I think that's Rio's advantage, right? It is a big mining house. It has lots of cash. It generates a lot of money. it can afford to take this sort of like medium term view, right? I guess it's also done its cost curve analysis. I mean, we take that for granted, right? So, it must be comfortable with what it's seeing,
Yeah.
where with the assets it's buying relative to where it thinks the lithium market is going.
But I think it's also interesting in terms of the quality of the assets and the scale of the assets that they will be looking at, because there's lots of junior explorers and developers in the space thinking that they've got what it takes. And I think the reality is, world class is there anything that's going to be good enough?
Technology could be the liberator. As I said, this direct
Mm.
extraction technology works. That may transform projects as well.
Yeah.
At the moment, I mean, you either got a brine or you've got a hard rock. Both of them have complex processing routes. As I said, just having the deposit, having the resource, it doesn't really get you down the production chain very far. So that's why I think, people are interested in say, okay, well, this is how we mined it in the past, but what if there's a different way, right?
Right. We better bounce on to one of the other major metals there that we've referenced so far, which is the biggie, copper. Now, are you a bull or a bear?
Yeah, both.
Bit of both. Okay.
Yeah, I mean,
That's called hedging your bets.
It's all about time horizon, right? I mean, it's at the moment, I don't know, I mean, it seems to be about fairly priced relatively. I know it's got a couple of, it's enthusiastically punched above $10,000 per ton. But, I do not sense that there is any great shortage of refined copper around at the moment. I mean, LME stocks are healthy. CME stocks, which fell to a ridiculously low level, so in the second quarter, and it suffered a major sort of like technical squeeze. They were rebuilding very fast. Chinese stocks, I mean, the world looks comfortably stocked for where demand is right now, yeah? But of course, I mean, it's copper. So as usual, we've got one eye on the pipeline of new mines coming on, almost certainly not enough. It never is with copper. And on the other hand, sort of like, it's still difficult to disentangle what I call traditional industrial cycle and new energy cycle in most of these metals. But there is no doubt that, I mean, copper demand is getting a boost from new energy applications. I mean, such as, whatever, if it's got electricity on it, if it's powered by electricity, it's got a lot of copper in it, right? So I think at the moment, when you look at China, for example, you look at the state of the property market there, which would be the traditional driver of Chinese copper demand. You go, wow, it looks terrible, right? And yet the reality isn't that bad. And we're kind of assuming that as traditional demand drivers such as property goes down, the slack is being taken up by more solar panels, more wind farms, more et cetera, more electric vehicles. So at the moment, there's this interplay between the two of them, right? But as time goes onward, the new energy side of it is only going to accelerate further, right? I mean, either that or we just do not achieve our carbon emissions targets. Doesn't really matter what you're thinking of, whether it's power generation, electric vehicles. I mean, it doesn't matter. It's all got copper in it, right? Nothing works without the conductor, and copper is the conductor here. So, on the medium-term time horizon, it's very hard not to be fairly friendly towards copper's prospects, just based on the demand profile. But that doesn't mean that it's going to happen right here, right now, right? I mean, there's still too much manufacturing doom and gloom out there, to sort of really, as I said, inventory's okay. There's no desperate shortage. You look at time spreads on the London Metal Exchange, they're telling you there's quite a lot of copper around. But I mean, the further forward you go, the more problematic the supply-demand equation becomes.
Yeah, obviously, I think growing populations and perhaps a need for renewed infrastructure builds, globally, that have been talked about by politicians. We'll yet to see. I don't know where the money's coming from. Suggests that the demand is there. I think the thing that I look to when I speak to these companies is this constant conversation around the hurdles in front of them, not just access to capital, which is obviously problematic. And I'm talking about new supply, not existing supply. Existing supply is struggling with having to, dig down deeper and finding lower grades, and but they are mining and they are producing. New demand is struggling with the issues of trying to find capital, trying to get through permitting and licensing quicker than they are currently experiencing. Some issues around social license, etc. And I think the kind of salutary number I saw the other day was the time from discovery through to production used to be 12.3 years, and it's now 18.6 years. That's another 50% longer than it perhaps used to be. So I guess the question is, whilst demand numbers may look encouraging, the supply into the future, into past 2035, I guess will give investors hope. But I want to make sure I'm not drinking the Kool-Aid and it's based on fact. So your view is short term, you think we're okay for copper. Longer term, I guess wait and see.
Yeah, look, I hear you completely what you say about permitting. I mean, this is a well-known problem. I mean, essentially, it comes down to popular resistance to new mines, right? Whether it be in the United States or whether it be Europe, people have decided they don't want mines built anywhere near them. They want processing plants. The answer is partly to go to sort of countries which are much more friendly towards sort of mining. So you're kind of thinking maybe Australia, or you're thinking Canada, and you're thinking within Europe, maybe sort of like Sweden, which has a long history of base metals mining, right? But there's a couple of other dimensions we have to kind of factor in here, right? Because this is one of the leitmotifs of the copper market. Where are we going to get enough copper from? Where's it all going to come from? Are we running out, right? And yeah, I get it, right? But two things I'm going to throw into the mix one. I'll tell you where the copper is. It's in the African copper belt. The clue's in the name. You look at some of the new finds that they're mining now in sort of like Congo. Look at the grades. The Chileans would give you by your arms off for sort of like grades that they can find. That's still the reality of the Congo, right? You can build plants faster than that. You can get permitting faster, right? But the problem is the overall country risk, which kind of brings me back to what I was saying about the Lobito Railway. How could we what would make Rio Tinto comfortable to have a Congolese mine, right? Well, we want the transport, we want green power. What if we could do? What governments could do that for you, right? I mean, it's sort of like we don't like the artisanal mining. What if we can incorporate that into it, right? There is a lot of copper still in the ground in the Congo. The issue is who's brave enough to go and invest and get it out. And the second big thing is recycling, right? All these metals, everything copper, everything is infinitely recyclable, right? We have grown accustomed, I think, to throwing away a lot of that resource, literally into landfill in the West, and/or we have grown accustomed to shipping it to China because we don't want messy old scrap recycling plants again in our backyard, right? But China holds the key here, right? A lot of consumer goods are recycled within a matter of sort of their lifespans are weeks, months, or whatever, right? Big stuff. Buildings, railway lines, all that stuff. That's kind of normally, most people expect that to sort of be recycled once every 30 years or whatever. Let me just remind you of when China's industrialization and urbanization started, right? We're coming up to that 30-year time horizon. A whole generation of buildings will have to be refurbished, right? This is huge amounts of scrap could be coming back into the Chinese system, and they know it. They've also modeled this, right? Their desire, if you like, going forward is that their own domestic recycling capacity will fulfill an ever greater part of their raw material needs or metals. So urban household recycling, I think in Shanghai, is only about 10 years old, if that, right? That's people taking their literally their metal cans outside. But I would say that could be a real delta of supply, yeah? If China suddenly, as I said, it's at the right stage of its industrial cycle for a huge wave of the first generation of metal used in this industrialization now comes back into the system. And I think, obviously, say a country like the UK, we had that phase, I mean, literally decades and decades ago. But then the question is whether we as a country can become also more efficient recyclers of metals. So don't underestimate the scrap component here. And don't underestimate it in China, which I suspect has actually banked on this for some time, as its way out of the copper squeeze.
Yeah, interesting times. For sure in copper. I'm trying to source better information that I think exists out there to try and make sure we are thinking about this straight. But like I think this conversation is very encouraging in the sense that we can remind ourselves that the federal governments across the world are investing in recycling and battery manufacturing, and that kind of thematic is strong out there in the market. I kind of wish there was the same sort of drive behind getting some of these new mines up and running, a little bit more complex. It feels like this. It is slightly combative, this kind of anti-China rhetoric in terms of protectionism, nationalism, etc. But maybe it's a necessity at the moment if we're kind of to break the mold in terms of those pricing extremes that we're seeing when China does flex its muscles. And I guess thirdly, it's nice to sort of see this kind of group with this kind of mineral security partnership coming together to say, look, it's time that big finance, big money got behind this tiny little mining sector of ours and help them get things over the line if we are to be serious about critical mineral security. That's my takeaway from this conversation, and
I mean, as I said, I think you're seeing growing momentum. You're seeing a growing understanding of the problem.
Yeah.
And you're seeing a growing understanding of ways of trying to sort of get around some of these problems, right? As I said, governments are new to this game, right? I mean, when did people start worrying about lithium supply? Really? I mean, 10 years ago? Less? Yeah, I mean, so, things like, particularly talk about the European Union with 27 member states, things cannot happen, as fast as maybe they can in China. But I definitely think, there is a more coherent policy response, which involves what I call the whole of the supply chain, right? So really from what comes out of the ground all the way through to product design for recycling, right? A complete lifetime view of a resource, right? And recycling will give it a new life. So I think that's kind of almost holds the key, right? Just to try and sort of go, we can mine our way out of this problem. It's not going to happen, is it? Could we recycle our way out of the problem? Not necessarily, but it could play a big, big part of it. Could new technology, completely new technology, help us out of this problem? Yeah, absolutely, right? You can be guaranteed right now that, there's universities across the States doing R&D into battery technologies you and I have never even heard of, right? Yeah. So I have no idea. Don't ask me. I'm not into that academic peer group paperwork, but I tell you, there is so much research now taking place into metals that we just didn't do to 20 or 30 years ago. New applications, new chemistries, and particularly the battery, the EV battery is a driver of that research. Obviously, everyone wants to break free of some of the metals that we currently put into electric vehicle batteries, such as cobalt. But R&D will solve you for that.
It's just fascinating. It continues to be, me having come from the sort of tech space and a bit of oil and gas as well. So fascinating to sort of see the way this market is playing out. Like, I think we've had a good chat today. Didn't even get to talk about antimony. We haven't talked about, this kind of very sort of this whole, maybe even some of this energy transition conversation that, people are also very hot and heavy about in terms of climate change, etc.
The way I see it, look, it is quite straightforward, right? My time, sort of on Earth, if you like, I'm quite an old guy now, has absolutely been determined by the politics of energy. But the energy was determined by oil and gas production, right? I mean, the world has fought wars over these commodities. Governments have set up like statistical bodies to try and work out what's going on in the air. Okay, that revolution, if you like, is coming to the end now. The next revolution is going to be metallic. At the moment, the only way we can decarbonize is replacing fossil fuels with metals. I mean, that's the only thing we've got at the moment, right? So I have no doubt in my mind we are entering a new metals part of mankind's history, if you like. But you know, it's the nature of revolutions. They come with turbulence, right? Revolutions do not happen smoothly. And this is what you're seeing. You're seeing a metallic revolution with every single sort of metal following its own story within that revolution, right? And you mentioned tin, right? I mean, tin's a completely different metal now from what we used this, 30, 40 years ago, right? But we can have this conversation with every metal because as the research budgets get switched on, guess what? We're finding more and more uses for some of these metals that have been around us for ages, right?
Yeah, I know. It's maybe this conversation for another day because I yet again, with every revolution comes revolutions, and then by that I mean we're also saying, talk of people who are perhaps anti the offshore wind farms which are out there. We're seeing that in the States, Europe, we're seeing it in Australia, etc. We're seeing people perhaps maybe struggling to get away from the use of coal, in terms of coal-fired power stations. There's a lot going on out there, and everyone's got an opinion, and that's what's so great about this space. I think as an investor, I think it's a great opportunities, but quite frankly, as even if you're a historian, if you are a futurist, you are interested in the space, or you should be. Andy, appreciate time today, as ever. Packed full of useful information, and we'll see you soon.
All right. Pleasure to talk to you again.